I am joined by Vance Spencer, co-founder of Framework Ventures. Vance, great to have you here.
Thanks for having me. Long-time listener, first time appearance, I think.
Yeah. I think it's your first time. So, Vance,
Yep.
you're very well known in the crypto world. You've had a lot of outspoken takes, and I mean that in the best possible way, just about sort of what's been going on in crypto and the turmoil there. But for a lot of my audience come from traditional finance. They're into the Federal Reserve, stocks, bonds, who might not be familiar with you. So, yeah, tell us a little bit about yourself. What drew you into crypto, and what sort of stuff do you do at Framework Ventures?
Sure, yeah. Started my career at Netflix in corporate development, worked there for 5 years, quit Netflix, started and sold a small crypto gaming company. This was 2017, 2018, when really nobody was even using games, let alone like crypto on blockchains. And that was a good experience. And used that money to start Framework Ventures with my co-founder, Michael. And we raised our first fund in 2018. We've since raised 3 more vehicles since that. Our last fund was 400 million. I believe we're one of the largest asset managers in the space today. And really kind of what Framework made our name on was the initial wave of DeFi. So Aave, Synthetics, Curve, Uniswap, all of those, the Graph, Chainlink, Wi-Fi, those became marquee investments that we led and really kind of developed alongside the entrepreneurs that actually built the protocols, like the DeFi, not only software and use cases, but the culture. And I think that's probably what we're best known for. Since then, we've gone into things like crypto games and front ends and infrastructure and security products. But really at our heart, we're a venture firm. We do take very concentrated liquid bets in our portfolio. That's just like a nature of kind of being an asset manager in crypto. But yeah, we love crypto, and it's been an interesting year. Certainly not as bullish as 2021, but I think it's a pretty good time to be here. And we're content where we are right now to slowly deploy and help bring about the resuscitation of the industry.
Yeah, resuscitation. Wow. So you launched during a bear market 2018. Very good time to launch. Interestingly, Blockworks, company I work for, was launched during the same time period, and it was an upward wave. And so if you have a crypto venture firm, you're investing in crypto, you like bull markets. At what point, Vance, did you begin to feel uncomfortable? Like, things might be a little bit too good. Everyone's talking about crypto. The valuations are sky high. There's a lot of sort of shenanigans that's going on that you is not healthy to see. What was the first thing you saw that sort of gave you pause? And then we'll take it from there.
Yeah, so we started in a bear market. In the last bear market, it was just so embarrassing. There were no use cases. Everyone basically hated us. Nobody wanted to talk to us about the fund, let alone give us capital. And we were very fortunate to have only one outside LP in our first fund, which was later very fortunate. But we were really looking for use cases at that point. And blockchains were built for value transfer, so it made sense that DeFi would be the first one to really kind of get some sort of adoption. And a lot of the reasons why I got adoption is because, I didn't have anywhere else that I could get financial services. I had a bunch of crypto, stable coins didn't even exist at that point. How would I even use this productively? How could I get a loan against it? How could I make it, productive? Like there just wasn't anything. And so Uniswap and Aave and Synthetics and Curve, like they came out and it made sense. And, we were the vanguard of staking assets and being aggressive on chain and being in these DAOs. And that first 2019, 2020, and I think the beginning of 2021, that felt very organic. It was the movement that was around in the bear market. We were all using the products. We could feel the value. We didn't know how big the market would be, but we thought it would be massive. And things started to turn with Saylor. We're going to put gold on or Bitcoin on everyone's balance sheets, and he started giving these weird webinars, and I got a little bit of red flags sticking up at that point, but I just thought it was part of the cycle. Elon started shilling Dogecoin. I thought that was just more of the speculative excesses of things like that. But really, when I started to sense that things were going south was when kind of the Metaverse and NFT stuff really started to pop its head up. That felt like really the most pure form of the excess in the market. And you had that along with the rise of FTX, and they're kind of getting into DeFi. And once they got into DeFi, I was pretty much on high alert. And we did make some moves around that time to kind of de-risk some of the portfolio. But when SBF and the FTX guys got in, it just felt like, there was sharks in the water, and they smelled blood. That was kind of the vibe that I got, at least.
Okay, interesting. So they had been involved. Sam Bankman-Fried started Alameda Research and then later launched FTX. Alameda Research was the prop shop hedge fund. FTX was the exchange. So they'd existed for a long time. But what made you uncomfortable with just how big they got, and also how had Sam Bankman-Fried's reputation evolved over time? I feel like to a lot of people outside of the industry, they had for some reason, good impression of him. And he was given a lot of positive media coverage. But were insiders like you skeptical of him? And how did your sort of thinking about him change? Why did FTX's rise make you uncomfortable? What were you afraid of?
Not afraid of anything, but I think a little bit of more context is that we've always been very vocally anti-SBF, anti-Solana, the centralization, and what we thought was a weird perversion of the values of why we got into the space to start. And so we've kind of been the perennial, bears on SBF. And, for a while that looked really dumb. People thought that, that was like not a great strategy, and it wasn't for a long time. But, spiritually, we're Ethereum people. That's what I think, we're invested in. And I separate Ethereum from kind of the rest of crypto because Ethereum is the thing that embodies the values that I really care about. Decentralization, transparency, an open permissionless platform that anybody can build or transact on. Those are the things that I care about. But when SBF really got into, DeFi was around the time that he raised for Serum, the SRM token. And, we had passed on FTT. We had entertained Serum and then passed on it. But we kind of kept tabs on the round. And I remember the thing that I remember the most was at a certain point during the middle of the round, they doubled the valuation from like 250 to 500 million. And we asked like why or who got what or like who would be in which tranche. And they just didn't really seem to care. It was really just like this run and gun financing to get as much value out of this prospective token as possible. And it felt like at that point, you had two versions of DeFi. You had DeFi, Ethereum-based, decentralized, robust, permissionless smart contracts. And then you had SBF kind of saying like, all right, you Ethereum kids have done all right. I'm going to take it from here and institutionalize it. And it's going to look like this. And once that happened, and once you had the bandwagon of Scaramucci and, all these big firms giving him money, it just felt like he was going to run with the DeFi idea and just make it a strange perversion of itself. And that's when it got a little dicey.
Yeah, so I just pulled up the balance sheet that was leaked by the Financial Times of FTX. And so before FTX basically melted down, they were valuing their Serum tokens at 5.4 billion and their FTT tokens at 5.9 billion. Can you talk about the valuation techniques? Basically, if why might those valuations be not accurate? And I'll specifically highlight just how few of them that actually existed were trading, right?
Yeah. So, the first thing is it was a 7-year lockup, extremely unheard of. And you kind of slowly drip fed tokens to the market. At one point, Serum traded at over $100 billion valuation. And I think it was like less than 2% of the float was available. And so this thing was like financial napalm from the start, designed to torch retail if they got anywhere close to it. And that is kind of the thing that made us feel deeply uncomfortable. If you look at a lot of the DeFi, the Ethereum DeFi fair launches and the token distributions, the tokens were given away for free, the whole supply in many contexts. If that wasn't the case, all the transparent vesting schedules were out there and people could understand where tokens were sitting relative to the fully diluted valuation. And that was good. But with Serum, they didn't seem to really care about any of that. We passed on it, and it felt like a dumb idea that we passed on it for a while, and people were kind of giving us shit that, SBF was going to be the next, the Warren Buffett, the JP Morgan, all of the comparisons that people make. But you looked on chain and you could see Serum and you could see the activity. And Serum, for people who don't know, it's a central limit order book. And so unlike AMMs like Uniswap, where everyone pools their capital together and you're trading against a contract, in Serum, you can actually see the makers and takers that are making the order book. And on a given daily basis, 90% of the liquidity was facilitated by Alameda. And so you just had this weird like Russian doll of like circular money flow and just what seemed like, at least if not fraudulent, then ethically dubious. And that was just the other thing that didn't sit well with us.
Yeah. And what was it about Solana? Because Solana is what's known as a L1 or a layer 1, which I don't really understand, but basically it's like a base layer upon which other things are built. So Bitcoin's an L1, Ethereum's an L1. Solana was sort of there are many others, but Solana was hyped as, oh, this can actually take over Ethereum. Ethereum is the dominant L1 in terms of applications right now, and it was a year ago. Many other layer ones, but Solana was, okay, it's faster, it has all these better things. You said you were a skeptic of Solana. Why? And then also, what's the relationship between Solana and Sam Bankman-Fried?
So, I mean, we're a skeptic of a lot of L1s. And, if you look at the valuation of these things, just, to give you a context of the whole landscape, crypto applications are actually fairly easy to value. You value them on a free cash flow basis, plus a multiple, assuming that they return the cash flows to the shareholders. Some tokens do, some are going to in the future, but that's generally how you value them. If you look at the DeFi applications, they trade at high multiples for sure, probably 50 times earnings. These things are growing really quickly. Like you don't really have access to this fast of growth in public markets, but that's a premium for DeFi apps, and they all trade within that range. If you look at L1s, the L1s have very, very little fees, but they have these huge multiples to justify their valuation. And why is that? An L1 is basically a euphemism for saying, well, this could be valued like Ethereum potentially at some point. And Ethereum is valued like it's valued, A, because it has a lot of fees, but B, it has this chance to become this form of internet money, this internet bond that pays you yield if you buy it and you stake it and you earn fees from the digital transactions that happen on chain. And so all of these L1s are basically martingale pumped towards where Ethereum is valued. And then, you hope that the VCs can get out by the time the fully diluted valuation converges with the circulating market cap. And these things have just torched investors, and that's why we don't like them. We've really never invested in any other L1s in ETH. And again, we're ETH people. That's kind of, what we're spiritually aligned with. And so, what's the connection between SBF and Solana? Some reports say that SBF owned 10 to 12% of Sol tokens. I think that's right, just based on kind of the flows that we've seen on chain and things that we've heard. So number one, that's crazy. A token distribution for something that has a chance to be money, one guy shouldn't own 12%. Imagine one guy owning 12% of all the US dollars or gold in the world. Just doesn't make any sense. The second one was, what was happening to the client funds on the back end? If you look at this whole L1 wave, layer one wave of last year, it was all based on Solana going really high in terms of price and everybody else saying, okay, cool. If Solana can get that high, maybe we can too. The problem with that idea in retrospect is that it is highly likely that SBF, in my opinion, sold his clients ETH and Bitcoin and bought Solana and the other Sam coins that were part of this, net worth calculation.
Yep.
And so that valuation model is broken. And that's the other reason that even in retrospect, we don't really like these old L1 investments. It comes down to the basic fact pattern of we need to build things that people want to use. We need to build things that generate fees. And that's kind of the whole point of the industry. And if you're not doing that and you're not Ethereum or Bitcoin and you don't have a chance to be money, I don't really know what the value prop is.
And yeah, let's do a little bit of a crypto health check. We're recording at the end of 2022. How would you assess it, given that we had the shocking collapse of FTX and potential contagion to other crypto firms? Genesis ending their halting withdrawals on their lending platform. Gemini's fate hangs in the balance. It has been hanging in the balance for a long time now. And then there are a lot of people saying that Binance has very similar issues to FTX. I mean, is it just FUD, fear, uncertainty, doubt, or is there where there's smoke, there's fire? So yeah, give us a crypto health check.
Crypto health check. We're down by 4 touchdowns at the half, and we got them right where we want them. I think that's kind of the perspective. It's so bad that it's good. We've washed out basically all of the really scammy and fraudulent products that were at really big scale. Carrying those carcasses forward just is not a good plan for the industry, and I'm glad that we got it done now. And so we've kind of washed the bad folks out. We've washed a lot of the credit and the leverage out. We've reset in the way that many industries do. But the ground truth is that, DeFi has product market fit. Games are starting to scale. It's not huge yet, but crypto games are going to be coming next year. And right now they have 100, 200K daily active users. If you have a few million a month, that's pretty good. We can scale that 10x and they'll be the biggest applications that are on crypto. ETH transition to proof of stake. The merge went successfully. There's a lot to be excited about. I also think it's just been a terrible year. I was looking at the Carvana chart the other day. It's just 99.5% down. It's, last bear market, it was just crypto. Mm-hmm. And everyone hated us and it was basically the same thing. But this time it's all of these assets around us have really taken it right in the face. And I think you kind of wonder, okay, will Robinhood ever hit its all-time high again? Will Carvana ever hit its all-time high again? What tailwinds are they riding? What's going to change about the business to make it successful? I have a hard time coming up with a bull case for a lot of those types of stocks, growth stocks, things like that. But you look at crypto, there's so much developer innovation. There's so many people that care about this industry. Regulation is now on the table, and that's a really positive thing. A lot of the application categories are starting to be proven out. Like, it feels like there's a lot more meat on the bone left in Web3 than there is in Web2. How many more SaaS marketplaces do we need? Do we really need another stock trading app? Like, those are the things when we talk to LPs, that's why they're still excited about crypto. It's, yes, it's bad right now, but there's a lot of tailwinds that we're riding.
Yeah, I'd say that sort of crypto in TradFi circles, crypto can be seen as like the hallmark of the everything bubble in 2020 and 2021. But I think in some regards that's unfair, because I think that in terms of total amount of dollars lost, I mean, I think the excess was definitely much more in SPACs, in SaaS companies that basically would have to be entirely new companies for them to ever be profitable. I think crypto is like kind of a convenient a scapegoat. I want to ask, how much do you think macro impacts crypto? Like, do you think crypto still would have had a bad year if the macro was more favorable and the stocks markets went up and bond yields remained low? And also, how responsible for crypto's meteoric rise in 2021 and 2020 was the favorable backdrop of negative real interest rates and tons of money printing and tons of speculative fervor? And also, are you a believer in the cycles?
The cycles? I mean, interest rates definitely had an impact. It had an impact on everything. And I think the most damaging, of the interest rates is not anything specific. It's the cumulative impact of all these animal spirits being removed by, stocks are going down, crypto's weak. It just kind of took a lot of the excitement out of the room. I do think it was going to happen, this crash, whether, now or later. Something like a Luna, just, it's a perpetual motion machine. It's not going to continue forever. Same with FTX. At some point, that fraud would have been found out. And if it would have had been at an even bigger scale, imagine if the DCCPA, the legislation that SBF was pushing, had passed, he'd gotten into the US, and then you'd blown up even bigger. Imagine if Luna had been, a 500 billion application. I'm just glad that the damage was relatively limited, even though it was deeply embarrassing. So interest rates definitely had a lot to do with it. And I think the other thing is that right now, and a lot of crypto's use cases are financialized. When you look at, the transactions on chain, you can see it in the usage. At the very peak of the bull run of last year, there was about 10 to 15,000 Ethereum per day being spent at about a $5,000 per ETH basis.
Spent as in being burned or being bought?
Being used for transactions. So like using DeFi, using NFTs, playing a game, transferring assets. So Ethereum was doing $75 million of revenue, that was pure profit per day, being passed to stakeholders at the top of the last bull market.
Wait, sorry, explain when it's being passed to stakeholders, it means if you were a validator, you were getting paid, but then back then it was miners. So sorry, what does that mean, 75 million?
So in a proof of stake world, and the proof of stake, the bridge contract had launched, last January. When you're an Ethereum staker, you stake your Ethereum, which you bought, and you earn transaction fees from it. You get about 20% of the transaction fees. The other 80% are burnt. So you have the deflation impact and you have the revenue impact that goes straight to you. But the point I was trying to say is last year, $75 million per day at the peak of the bull run. Right now, you look, there's about 3,000 or 4,000 ETH being spent per day. And it's being spent at around, $1,200 cost basis right now. Mm-hmm. And so that's about 6 to 7 million. And so the revenue of Ethereum, the use cases have dropped 90%. And so it's not just like this speculative bubble that had deflated. People are actually using crypto less as a result. And that has been the impact of the interest rates, in my opinion, because a lot of this activity is currently financialized, but that is okay. That is how we actually build useful applications. We actually need this.
Right. Okay. So a lot of that 90% fall in activity is just due to the token price collapsing. And this is something that, I first got into crypto, like many people, in near the top of 2017. And I started looking to the valuation metrics, and a lot of them were just purely based on how many the total dollar amount of transactions per day, and it drove me crazy because if the coin goes from $1 to $100 and the volume stays the same, the daily traded volume is going to go up 100 times. So it's ridiculously self justification of valuation metrics.
It's super reflexive, which
exactly.
is it's good and bad. George Soros would say this is an industry that can generate its own valuation at any price, because it's circular, right? But on the downside, it can collapse 90%. Our hope is that this stabilizes eventually, and we don't actually have to go through this, and that we provide these useful use cases which persist versus bull and bear and don't rely on the token price itself.
Right. Okay. And so under the current proof of stake model, validators are paid, but that only happened recently because of the merge. So how was it that the fees were being generated under the mining system? And then you also mentioned something about a bridge.
So Ethereum launched what was called the Beacon chain. And the Beacon chain was effectively the placeholder chain, which we're now operating on. But you could stake your Ethereum there, and it worked in parallel with proof of work. And so the proof of stake people would be earning rewards from the Beacon chain, and the proof of work miners were actually earning rewards as well.
Staked ETH, Steth.
There's a few different forms of staked Ethereum. There's Steth. There's like staking it through like Figment or Coinbase or things like that, where you don't actually get a receipt token, but like it's kind of all the same thing with regards to staking Ethereum and getting rewards back. Okay.
So activity is down, but also the dollar value is down. So that makes sense. In terms of, you said the valuation metrics for DeFi projects are relatively simple. Walk us through that for Ethereum and other things you track, because I think a lot of people think of crypto as something that has no valuation metric, and I think for something like Bitcoin or most L1s, or a lot of if there are 20,000 crypto projects listed on CoinMarketCap, a lot of those would be impossible to value on something that a traditional value investor would consider a valuation metric. But it sounds like you're saying that some of them are, and I'm really interested in that. So tell us more.
There's not a ton. There's 10 or 15 or 20, and I think that's totally fine. Like some people choose to see the hundreds of projects that didn't make it and the copy paste projects that were very low effort, but there are actually a few projects that are generating mid 8 figures, low 9 figures of revenue, and that are passing it to token holders in some way, shape, or form. And that ranges from Ethereum, which is probably going to have, 2 billion of earnings this year, to things that are smaller like MakerDAO and Lido, which, Lido will probably have 60 million of earnings. MakerDAO will probably have, probably 100, 110 million. And Lido is a liquid staking protocol where they actually facilitate the asset Steth, and you stake ETH and you receive Steth. And the Steth allows you to have a receipt token, so you can actually use liquidity, use it productively, but you also still accrue rewards to that token. And the thing that Lido provides is a validator set to Ethereum to run the actual protocol. So they're downstream of Ethereum making money there. MakerDAO is a stable coin. You can look at it as, kind of like a bank, but they have their own currency. And they have, they earn a spread between the lending rate and what they charge people. And they also earn money for printing DAI and giving it to people like Coinbase, who then go buy treasuries and give MakerDAO, some of the proceeds back. And so are these business models a little strange? 100% they are. But I think that's the point. And the really cool thing about them is they cost very, very little to run. Look at Lido, 60 million in earnings this year. The DAO spends about 10 million per year in software maintenance costs. But if ETH goes up, if yields go up, if usage goes up, Lido is going to have, a 10, 20x increase in cash flows. And that is going to be the thing that scales while their operating costs stay the exact same. And those are the very powerful business models that are only facilitated by open source software built on blockchains, that I think is the really interesting thing in the shadow of this growth collapse in tech. Why did the growth stocks collapse? Because none of them are actually profitable. They couldn't actually scale their unit economics beyond their costs. But you look at these things on crypto, and there's not a lot of them. They're kind of strange, but they actually have the operating leverage, which makes them able to, justify these big valuations and big multiples. And if you think that crypto is riding tailwinds, these revenues are just going to increase to the degrees those tailwinds play out. And that's what's exciting.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. All right. So you worked at Netflix. Yeah. Can you just speak to big tech? Because, things like Google and Apple are just money printing machines, and, Meta, Facebook formerly was a cash printing machine. But yeah, so many businesses that we assume are profitable, if you look at the numbers, just are simply not. Like I'll just name Warby Parker. Everyone wears Warby Parkers, but I looked at the financials, and after the stock had been down 80%, and it's still, nowhere close to making money.
It's not just, brick and mortar places either. Snapchat has never turned a profit. How do these things continue to go on as a going concern? And I think in the 2010s, it was a lot of debt, and a lot of low interest rates, doing stock buybacks and recapitalizing the company. But I think at the end of the day, a lot of these things are just not going to stand the test of time in terms of being able to scale out of their operating costs. And, it's not like these things are not being used. There's, my nephews, my cousins still use Snapchat. It's a huge cultural thing. It's just that they're getting squeezed by Apple, and they don't really have that much pricing power to start with. And that is symptomatic of a lot of the kind of mid 2010 style businesses. But I think Elon's going to run the A/B test with Twitter in real time and see if you can actually buy one of these things as kind of like a private equity style play and strip the costs out and keep it running. And I think he's going to be successful. I don't think you can do it with places like Snapchat because Evan Spiegel has all the votes. Netflix is probably too big to even consider doing anything like that with. And so it's going to be interesting to see how it plays out. Because a lot of these things can never be profitable. A lot of these things have governance problems. A lot of these things just all the best employees have left to go do something else. It's going to be a weird time for tech. It's like a midlife crisis.
Let's just talk about Genesis and the Grayscale Bitcoin Trust for now. Because that seems like a big shoe to drop if it is.
Yeah. So to take it back to where it started, it all starts with this asset called GBTC, which is a trust. And the trust works as follows. You can put Bitcoin into the trust and you create GBTC. You get charged 2% per year for putting your Bitcoin in. That's how Grayscale makes money. But you cannot redeem. There is no redemption mechanism because it is not an actual ETF. And so the only way to get out of this is to sell your GBTC. And, this wouldn't sound like such a bad idea at the start, but if you consider it, in a different light, it's like there's this money in a box and you can't take it out and it's only worth whatever people will pay for the box. And so how do you actually value the box? And there's maybe, in the distant future, in 4 or 5 years, like a vague promise that the box might be open and you can take the money out. But that's the basic value proposition. But instead of it just being like a box with money in it, it's a box with Bitcoin in it, but you can't actually get it out. And so you look at, and Sue and Kyle were people that I met in the last bear market, and
who
they
are they?
seemed like,
for our audience, who are they?
They're the co-founders of 3 Arrows Capital, a very large Singapore-based hedge fund, or was a big Singapore-based hedge fund. I think at their peak they had 10 or 12 billion of something of assets. I don't know if that balance sheet was correct or not. There was allegations of balance sheet fraud and things like that, but we can get to that in a second. The first time that I really saw them operate at scale was they announced that they had, I think 7% of the GBTC trust. And it was something like 270,000 Bitcoin. And kind of how I had known Sue and Kyle was medium-sized traders, punch $1 million ticket on a trade, something like that. The idea that they would have 272,000 Bitcoin lying around was crazy to me. And so at that point I was like, they had gotten access to some new source of capital. And the fact that it was GBTC, and Genesis had been known to lend to them, kind of made it seem like it might be more of like they were doing something together. And I think the non-charitable version or interpretation of the events that followed were Three Arrows gave Genesis BTC or GBTC. Genesis would give them back US dollars, which they would then use to buy GBTC, which they would then post to Genesis, and they would get more USD, which they would buy GBTC again. And so like Genesis would allow them to like circularly lever up. And
Wait, I'm sorry, I'm having a hard time understanding this. So there was a time when the Grayscale Bitcoin Trust traded at a premium, and then it traded at a discount, and the discount has only gotten worse. Which of those two, premium or discount, was an arbitrage opportunity, and which of those two sort of burned people in the space? Because I know when it was trading at a premium, you could buy Bitcoin, present it, and then be given GBTC, which you could sell, and that was a nice arbitrage. So which of those trades burned people, and which was burned in 3 Arrows Capital? How did they end up owning 6-7% of it?
So it wasn't like, it was two distinct trades. The wrinkle in trading or creating GPT shares generally is that I will give you Bitcoin, and then 6 months later, you'll give me GBTC. And so if I give you Bitcoin at, a 60% premium, and then by the time that I go to actually get my GBTC shares, it's now a discount, I just got completely hosed.
Yeah.
And so you kind of needed to luck out on that 6 month timing window. And like, it's funny, like you can see the premium persist for like 6 to 7 months and then just like drop off the face of the planet. Cause you could just tell that someone had really just taken their shares and then hit the bid and collapsed it. But like that was my theory in terms of why 3 Arrows initially got in trouble. They were circularly levering up this GBTC trade. They had to wait 6 months for shares. And by the time they actually got their shares, the discount was so material that they kind of got blown out on their original loan. And that probably is what created a lot of the holes in a lot of these lenders' balance sheets. And I think that 3 Arrows still owes DCG and Genesis like $600 million or something like that. So they blew up pretty good.
Yeah, they blew up pretty good. And then there were other CeFi lenders, centralized finance lenders, where you could earn yield. And then I don't think this is a big feature of the 2017 bull market. Didn't hear yield a lot back then. But in 2020 and 2021, it's all about yield. Oh, you buy Bitcoin at $10,000, it goes to $60,000. Vance, that's great, but that's just the beginning. You can stake your Bitcoin and you can get paid 10%, 20%. And then there were protocols that were paying 80,000%. I mean, I still don't understand how these things generate the yield. So I guess there's two buckets. One, the palpably ridiculous, DeFi yields and how that worked. And the second one is the ridiculous, but at least it could seem like it's a totally different model of 10% yields that actually ended up causing more destruction than the openly ridiculous yields. But yeah, I guess let's start with that. Like when Celsius said, "Oh, you can get 10% or 15%," where did that yield come from?
That is a great question. So the funniest part is like, we were very vocally anti-Celsius, and there's a lot to unpack there. We don't need to get into it right now, but basically, their CEO would go on CNBC and say things like, you can stake your Bitcoin with us. There is no staking for Bitcoin. Bitcoin is a proof of work system. It does not endogenously generate yield. And so, the question is, how is he getting yield on that? Well, there's a few sources of native yield for Bitcoin. You can lend it to someone who goes off and takes the risk to create GBTC trades or shares. And, if they're lucky, they time it right. Or if they're unlucky, they kind of get blown out. They probably got blown out lending Bitcoin to people who did that. The other one is just lending it to people who would sell it for dollars and then who would go buy other assets. And then you're short synthetically Bitcoin that you owe customers, and you're long other assets or you're long this credit agreement. But this was not a feature of the last cycle. The idea that, things like BlockFi and Celsius and Voyager could quasi act as banks because of some weird exemption around digital assets and, rehypothecate and do fractionalized banking and they had terms of service, which people thought that they were just depositing into like a Coinbase style exchange, but instead it was, your property now belongs to Celsius and we can do whatever we want with it. Not surprising that we got torched by that in retrospect. I think there was some hope in the industry that these things were better managed generally, but I think the incentives were so skewed to lend and get yield and get returns that the industry kind of got ahead of itself.
yield on stablecoins being high during a bull market makes sense to me, because if everyone wants to get leveraged long Bitcoin, they could borrow at 8% and 10%, and that can be a profitable business. But in a bull market, it doesn't make sense to me why Bitcoin would generate 10%, because to me, the reason that you borrow something is to short it. And who wants to short something in a bull market?
I mean, yeah, it's the weird part about Bitcoin and why the fund has really never held Bitcoin in any meaningful capacity is, if you get Bitcoin, what can you do with it? You can't stake it. How can you get a loan against it? Well, you need to send it to some centralized counterparty and get them to send you dollars, and hopefully your Bitcoin comes back someday. If you have wrapped Bitcoin, at least you can put it in DeFi and make productive use of it. You can do different things. You can generate yield with it. You can, get a permissionless loan against it. Really, Bitcoin became this, I don't want to say toxic asset, but it just became where all of the problems really started to occur, especially because the GBTC trade was so levered. And yeah.
Okay, tell me about that. So this is a macro show. I'm not a Bitcoin maximalist, but I feel like a lot of people who are closest to the macro in crypto are tend to focus on Bitcoin. And you are, you're an Ethereum. You like ETH, not Bitcoin. Well, I may grant you that the lack of utility of Bitcoin, but yeah, why? Where do you see the problems of Bitcoin in terms of the cycle? Weren't the problems in terms of the centralized lenders that lent against it, as well as the sort of promise of all these yields in DeFi?
So I think, to do a non-exhaustive list of Bitcoin problems last year, the first one, and really the only one that I care about, is just the lack of transaction fees. And the lack of transaction fees has no connotation of whether Bitcoin is good or bad. It just has a connotation towards people using it or not using it. And people do not use Bitcoin. You can see it in the adjectives that are used to describe it, hodl, or, put it away in cold storage and never touch it. Or, this is like money for the next 1,000 years, like Saylor would say. It's a culture of dormancy and not using it. And if you look at Ethereum, stake it, swap it. You can use it for NFTs. It's the internet money of crypto. It is an internet bond that generates yield. There is so much that you can do about it. And the community is building new apps and new front ends and new ways to use it. That's why we like ETH, and it's borne out by the transaction fees. ETH right now has no inflation because it is so used and it burns enough ETH to keep it at neutral. Bitcoin has 4% inflation per year. Minor capitulation is the biggest issue in the industry right now, and it's just crushing the Bitcoin price.
Minor capitulation, okay, meaning, yes, so the total amount of Bitcoin, it goes down, hash rate, whatever. I'm not going to pretend to understand it. But you're saying, yeah, the miners who have mined it, they keep it on their balance sheet. First of all, the miners, what's going on with the miners? Okay, why, if you have a copper company, you mine copper, you might hedge a little bit by selling some copper futures, but you be safe. But I don't think Bitcoin miners, they don't short Bitcoin miners to hedge, do they?
They do, and that's what a lot of the industry of the futures and BitMax and that stuff was created to do, is allow Bitcoin miners to hedge. But Bitcoin miners don't hedge.
Yeah.
They're kind of playing the same directional game as everybody else, where a Bitcoin that they mine for $5,000 is going to be worth $100,000 someday. And so you have that. And I think the other thing that I think about is it looks like real estate to people in a strange way. I have this physical asset that I put in the ground, and I turn it on and it generates yield and it pays for itself, and I can pay down the debt. But it's just not like that. And the crypto industry is not stable enough to invest in like the real estate industry is. And, even today, Core Scientific filed for bankruptcy, and you look at all these miners and what are the first things that they start to sell when things get bad? It's their Bitcoin. And then they start to sell their machines, and then they try to keep the lights on, and then they all file for bankruptcy. And this is like the third cycle we've done this. And, Ethereum doesn't have that problem. You just have people staking ETH that they own. It's software.
Right. So your criticism of Bitcoin as something that people want to hold rather than use, I've thought that criticism, and I've shared it publicly before. It's like the hardest money isn't necessarily the best money. If I'm super bullish on Bitcoin, why would I ever buy coffee with Bitcoin? Because buying coffee with Bitcoin is going short Bitcoin. It's selling Bitcoin, right? My question is, in what way is Ethereum different? I presume you sound like a guy who's pretty bullish on Ethereum. Why would you ever use Ethereum or ever use Ether if you think it's going to go up, because then you're just getting rid of it.
I'm not asking you to buy a cup of coffee with Ethereum. I'm asking you to use stablecoins. And when you use stablecoins, you pay the network gas. When you pay the network gas, that becomes a transaction fee. When Ethereum has more transaction fees, the security of the network gets even better. There's lower inflation. People earn more yield for holding Ethereum. And so, like, I don't know if ETH is money. I think it's more like an internet bond, where if you think of all the transaction fees and the sources of security that are keeping the network up, it's people that are sending stablecoins, sending remittances, using DeFi, using NFTs. And at some point, if we have bad inflation enough where, we all need to, get guns and, provisions, and we're using Ethereum as money, like, I think that's okay. That's certainly not the world that I'm kind of gearing towards. I'm a technology guy. I see developers building applications. I see new emergent behavior, and I see this thing generating tons of free cash flow at basically 100% margin. And that's what gets me excited. I'm not a doomsday prepper. I don't have, Bitcoin and gold in my basement. It's just like not how I live my life. And I think that's where crypto is going. It's going to more of a pragmatist, less of an ideologue type of market.
Right. Okay. So walk me through the valuation of ETH. How much free cash flow does ETH generate? How does that compare to the total market cap of ETH? And then if I can throw another question, what is the percentage? What does the pie chart look like of, 20% comes from NFTs, 20% come from stablecoins versus other things?
So this year, Ethereum will do probably about 1.5 to 2 billion in revenue. And I'm just like looking at my chart over here. That puts it at, and this, it fluctuates based on, the spend of ETH per day. That's at least how I think about it. I think about it on a daily basis. And so some days when NFTs drop or games launch or things are more bullish, you're going to get like, 4 or 5 or 6,000 ETH spent at 1.2K per ETH. Some days the price of ETH will rise, and so the revenue will rise even more. And so it's pretty volatile, but it's trading at around 150 to 200 PE, on a general basis. And, is that expensive? Yes, it is. But the promise of Ethereum is a new type of computer, a new type of money potentially that's extremely leveraged towards this digital economy that's building on chain. And so, you kind of have to make a judgment call on whether to pay for that or not, whether that's too expensive for you or not. But the point is that it has access to this new market of becoming money. And that is why, in my mind, it has such a valuation premium. If I can hold Ethereum, use it as money, and earn yield on it from everyone else using it, that is something that does not exist in traditional technology today. I did a study. We have a lot of engineers on our team, and all of this data is open source, and it updates every 13 seconds, every time a block is confirmed. So it's really cool. You can see financials in real time and look at it. And the question I had was, the higher the Ethereum price, the less people should want to spend. Like that makes sense, right? But actually what I found was the opposite. And what I said before, when Ethereum was at $5,000, $4,900, whatever, people were spending 10 to 15,000 Ethereum per day. And when the price is lower at 1.2K, people are spending, 2 to 3 to 4 to 5K per day. And so it's this weird Veblen money good where the more expensive maybe it reflects the bullishness of the space, maybe, it explains all these emerging applications. The higher the price of Ethereum, the more people want to spend it. And, you can say that that's a good or a bad thing, but it is reflexive by definition. And that is, I think, what I look for in a lot of things in terms of how big of a market can this get to? What is the level of escape velocity it needs to achieve to really get there? For Ethereum, it doesn't actually look to be that high because people spend more ETH the higher it goes. And again, that's probably a reflection of more of a bull market than anything else, but the point still stands.
Yes, but that also means that they use ETH less the lower it goes. So my question is ETH, even though the price of ETH is a fraction of what it once was at the highs, is it now more, quote, highly valued, has a higher valuation than it was at the peak of $4,800 per ETH?
So the answer is that the price has gone down from $4,900 to $1,200. Mm-hmm. Meanwhile, the amount of ETH spent per day, and so call that an 80% decline. Mm-hmm. And the amount of ETH spent per day has also gone down probably about 80% as well. And so on a relative basis, those two should net out. The price is 80% lower, but the amount of ETH spent per day is also 80% lower. And so, maybe it's a little bit over or under on a daily basis, but generally it's reset within the same type of valuation band as it was before.
Okay.
So let me put the converse to you to explain it. If Ethereum price had stayed the same,
yeah,
and the amount of ETH spent per day had declined 80%, then it would be 5 times higher in terms of its price to fee valuation ratio. But if they both drop at the same rate, then it should equalize.
What would you say are the contagion risks within crypto going forward? We've seen them. Celsius went down, that causes problems for FTX. FTX goes down, that causes problems for Gemini. But what's next? What do you think are some of the next shoes to drop? Are they mostly in the centralized finance, the CeFi space?
I do think like the obvious ones are Genesis and DCG resolution. I mean, I've actually been impressed by how specifically Gemini has handled that with Houlihan Lokey. They're putting together a thoughtful plan. They're being very transparent and public about it. Like, I'm hopeful that gets to a good resolution. Seems like Grayscale is kind of off the table in terms of being wound down and distributed. And that was like a big thing that was scary, a week or a month ago. Just because that's, 10, 15 billion of sell pressure of Bitcoin and ETH coming to the market if that has to happen. There's still a lot of lenders that are kind of like, coming out of the woodwork, raising their hands saying like, yep, I got killed too. But that's, those are the smaller ones, a lot of Asian ones as well. I'm trying to think, Binance, I don't think is insolvent. They have $64 billion in a cold wallet. CZ is generally good for the money. I think there's like a weird translation barrier between the East and the West, like seeing him on CNBC and they're kind of asking him these like potentially somewhat misleading questions and he's kind of like messing up his answers just because there's a little bit of an accent there. I don't think he's actually, in any sort of trouble. Maybe Bybit, that's another one. A lot of retail Southeast Asian exchange. Like we don't really know what the state of their reserves is, but all of the big ones have been taken off the table. Is it a bottom? We don't know, but it feels like there's been enough pain where if you look at the 2018 fractal, same thing, had the big collapse earlier in the year. We kind of hung around at the same level. And then in December, November, at that point, the miners capitulated in 2018, but at this point it was FTX, but it looks very, very similar. And so that's at least the hope.
Mm-hmm. So what percentage of ETH like revenues, roughly, you don't have to look it up, come from stablecoins? And then is that all stablecoins or just a small number of them? I know the biggest stablecoin is Tether, which is I think more than half of all stablecoins in terms of size.
Let me look. And for people that are out there, if they ever want to look at Ethereum use cases and where the burn comes from or where the revenue comes from, ultrasound.money on a daily basis gives you a really good idea. And so today, OpenSea is the number one consumer of Ethereum gas. Uniswap is the number 2. Transferring ETH is number 3. And then Tether is, 6 or 7. So it's actually pretty good dispersion in terms of like use cases. Would like to see those 10 to 100x higher in terms of the aggregate ETH spent, but that's kind of what the crypto economy looks like.
Okay. So Tether, it's all stablecoins. So Tether is on ETH. Tether doesn't have its own blockchain.
No, Tether's on ETH primarily.
Okay, Tether's on ETH. Okay.
Yeah.
Okay, got it. So while we're talking about FUD, what do you think about Tether? They release attestations, but they don't haven't released an audit. I feel like if you and I were made a stable coin and everything was up to snuff, you and I probably would want to release an audit to let the world know that we're everything's good, 100%, good to go, right?
Like Tether is another one. I used to think I used to be like a Tether truther. It's gonna blow up, all this stuff. I've just seen it go through enough stress tests, and in June or whenever 3 Arrows happened, they did like a 8 billion redemption within 12 hours or 24 hours, and that was the first really big stress test that I saw that it made me feel very comfortable with it. And their attestations aren't perfect, but I kind of take them for what they're worth, knowing for, a lot of people in crypto that they are able to redeem they are able to talk to Bitfinex and Tether and actually get USD redeemability into their bank account. So I'm not too concerned to them. Do I think that they probably did some cowboy stuff in the past? Probably. And that was, I guess in their opinion, in service of bootstrapping the ecosystem and the use case of Tether. But I tend to think at, 70, 80, $90 billion stablecoin scale, you've had that cleaned up. And I think they have. That's at least my guess.
Okay.
TradFi funds do love to short Tether for many different reasons. I think it's mostly just personal animus against the crypto space. I don't think anybody's really made any money shorting it. But it seems like a sexy thing that you can pitch to LPs. That's my guess.
Yeah, right. Well, I think it's a stable coin. Correct me if I'm wrong. It's one of those things where it's hard for it to be worth 90 cents on the dollar. It's either 100 cents on the dollar or it's going to go way down, right? Like
right.
Yeah. So, all right. So yeah, well, I mean, so we are in a crypto bear market. How are your investment strategies different now? Are you, more thorough? I mean, I presume you always be thorough, but like, are you just taking less risk, or do you think it's now time to double down? What is different about investing in a bear market for crypto than a bull market?
I mean, the last bear market, I'd put all of my money into Framework and ended up living in my co-founder's parents' basement for a year starting Framework. And so I've seen like how bad it can get. And you have to change your strategy when the market changes. And so whether it's distressed stuff, whether it's, more liquid stuff, whether it's being more aggressive on negotiating on the venture side, those are kind of the three strategies that we run. And we are just subject matter experts in this asset class. Nobody knows this stuff better than we do. Nobody knows these tokens, these companies, these people like we do. And so that's our advantage, especially in times like today where we have a $400 million fund. We're one of the only people with cash, and it feels like we can really clean up. And so, our plan is for this to be, our finest hour and really take advantage of the situation like we did with our first fund. It feels a lot more measured, seeing less projects, higher quality, more reasonable valuations. But, things are playing out, the use cases, and that's the things that we keep our eye on. And if that keeps happening, I don't really expect this to be a super long, protracted bear market. It's already been a year, more than a year.
Mm-hmm.
And so, if it's next year, if it's 2024, I'm very confident where crypto is today, just because in the last bear market, there were literally no people. There weren't even any use cases. It was hard to see the forest for the trees, but now there's a map, there's a plan, and it feels like it's just a matter of time.
All right. And tell me about the gaming side. You said you were really excited about gaming. What sort of projects are there that you are excited about?
Yeah. So just if you go by process of elimination, NFTs are too niche for the general public. Music, as an application category, hasn't really taken off in crypto. Content, I don't know if there is really a good application yet that's been built for, distribution of short form content or of creator content or things like that. Games are really, by process of elimination, the thing that are going to bring in 1 billion users over the next 2 years to crypto. And you have a lot of headwind or tailwinds on that thesis. If you look at Apple's most recent iOS update, which removed IDFA, that really crushed. And IDFA is how you track users across mobile, across desktop, across different devices for, basically free to play advertising based business model games. The removal of that standard really hurt those people. And so, some of it is people wanting to get into crypto. Some of it is people being pushed away from these Web2 platforms that are increasingly gatekeeping and taking more of their revenue. But we see more games pitches than anything. And these games, the first cohort of them got funded in early 2021. And so only now are they starting to release their product. But we're seeing amazing things where people are playing these games that they love, that they think are fun, and they don't even realize that there's crypto on the back end. And so, again, it has not been 100 million, 1 billion person breakout hit yet, but we're seeing things at a small scale, which are, the thesis is starting to play out, and you get people to come for the game. And the hope is that they stay for the decentralized financial tools, the interesting things that you can do on chain, the community that's built around crypto. And that's, I think, the key here is how we make that pivot. But that thesis is starting to play out, and it's going to bring a ton of people on chain, and more people on chain means more use cases. More use cases means more transaction fees. More transaction fees means the blockchains are more secure. And so there's this virtuous cycle of, you add more people in and you really get a different type of state on chain. as a result. And so that's what we're looking forward to 2023. At least one thing that we are.
And the games have to be good.
They have to be good, and they can't just be financialized.
Yeah.
Like the last cycle was Axie
Infinity, yeah.
and all of these like financial napalm applications. And all of the games that we see now, they're not based around this reflexive token economic loop. They're based around gameplay, and maybe the swords are NFTs, or maybe the virtual currency is actually tokens on chain. But even that is enough to give games 20, 30, 40% better monetization. In an industry the size of gaming, that adds up to a lot.
What now is the biggest crypto game?
What now?
And how many users does it have? Roughly.
I think it's one called Neopolis, and it's got about 3 million monthly active users. It's a game like Foursquare, where you check in, you can become the mayor of places, you can decorate your place that you've claimed as mayor, you can steal other people's places, and the NFTs are on Solana, and people don't even really know they're using them.
Really? Okay.
There's another one called Pixels, which is built on Stardust, which is a platform portfolio company of ours for game developers, and I think they probably have like 1 million. And it's kind of a typical fast casual style game that you might see on the iOS App Store. The thing to keep in mind with crypto games is that hardcore gamers hate them. They're like uniquely positioned to offend those people. But the meat of the gaming industry is these fast casual games. 30 to 50-year-olds that are playing games to generate some passive income, have some fun, but that's kind of about it. The games don't need to be like these infinitely deep Halo style, Call of Duty style, story epics. They're going to be much simpler.
Mm-hmm. And if you and I were to go onto one of these games, in some ways, it's kind of a metaverse because we're doing in a world that's not real life, and we're transacting with NFTs. But is the metaverse different than that? And then also you said, part of the reason I got a little, maybe things were too good, got a little skeptical, was like people started talking about NFTs and metaverses. What's going on with the metaverses, and then we'll just go into NFTs.
To be clear, I think the metaverse, even though it's pretty ambiguous as to what it actually is, and NFTs, I think it's just like a technology standard. I think both of those things are not inherently bad. Mm-hmm. They were just really poorly defined. And when I see like pictures of monkeys smoking cigars trading for $500,000 each, like it just doesn't feel like the best use of our time. Or like just being honest, this doesn't feel like adoption. That feels like something else. Metaverse, it got conflated with Zuckerberg changing Facebook to Meta and, him building his stuff. But for me, what the metaverse is how can I go to a computer, for free and start earning money? It is a way it's basically employment. People are not just going to go hang out in your metaverse because, you have an Oculus and they have an Oculus and let's go hang out in a virtual park. There has to be some reason, maybe it's dating, maybe it's, who knows? But like the most clear and present version and the most immediate source of inspiration for people to go on chain is because they can make money. And I think that's actually a good thing. And our hope is that, you're not making millions of dollars from playing these games, but you're doing something of value that the developer benefits from, and you earn some sort of piece in the upside. It doesn't just go to them, and you can start to build this life for yourself on chain. And that's very similar to how, I live my life. I have large chunk of my net worth on chain. I use all of these decentralized financial services instead of, getting mortgages or loans from a bank. The art in my house is NFTs, and I'm sure the digital artists are benefiting from that. I'm sure the protocols are benefiting from me using it. And I built a life for myself. And that's kind of what I consider the metaverse. I don't think it really has much to do with VR or AR or any of that stuff. It just has to do with, financial sovereignty. And I think really only blockchains can offer that, specifically Ethereum.
Right. So the biggest metaverse platform now, I think it's still Decentraland. You're saying that the metaverse doesn't have to be a game where we're all plugged in.
No, to me, like when I use Ethereum to do DeFi or do different things, like send stablecoins to people, that feels like the metaverse to me. If you have not used Ethereum and you're listening to this podcast, go get some ETH, send it to a wallet, send it around, play with it. It feels like magic. It's one of those transformative technology experiences that you remember the first time you tried it, and it's really interesting. And to me, I don't know how people define the metaverse, but that feels like it. Ethereum feels like magic when you use it.
Okay. Going back to FTX, like who, traditional finance, if I am a firm and you either lend me money or have a deposit with me and I go bust, you're in trouble because what you thought was an asset was with me and I'm trouble. So if I'm trouble, you're trouble. Who what sort of companies had um accounts with FTX? A lot of individual investors, I'm sure. You don't have to name specific names unless you want to, but yeah, what sorts of companies would have accounts with FTX? Would it be hedge funds? Would it be market makers? Would it be decentralized DAOs? Or was it a pretty even balance between those three?
I think it was on a account of customers basis, probably more of a retail and more of a the Europe and other people who wanted access to derivatives and things like that. On account of customer basis, it was probably skewed more to retail. On a dollar value of assets on the platform, FTX was primarily a honeypot for these large trading firms that needed access to derivatives, that wanted to do different types of hedging activities for either locked positions or things that they were doing on chain. And that was really the people who got hit the hardest. You can see Galaxy, you can see Wintermute, you can see Galoy Capital, you can see a lot of the MGNR got hit, and these are all crypto native prop trading firms. Really, it was a honeypot for them, and those were the people who were also the most ardent believers in the multi-chain future, the Solana vision, the SBF is Emperor of the Universe vision. And it's unfortunate, but they all kind of got burnt as a result. And we didn't lose any money on the platform. I believe we did have an account at one point, but yeah, it was a honeypot for those types of people specifically.
Mm-hmm. So if there are whales who have accounts on FTX and what they thought was an asset is in the immediate sense with zero, it may get some amount of sense on the dollar in the longer term. You'd imagine that's trigger some selling pressure of their other assets. Bitcoin, Ethereum, it goes down the list. We have had a rapid collapse in prices, a crash in prices. The few days around FTX, but for over a month now, it's been pretty stable prices in Bitcoin and ETH. To what do you attribute that? Pretty much, it's kind of a standstill. Why is that the case?
I don't know if it's been a standstill. If you look at the June Celsius 3 Arrows Luna collapse versus the FTX collapse, there's been a lot of dispersion. Ethereum has not made new lows. Ethereum hit 900 in June, has not gone back there since. Bitcoin hit 17K in June, has gone below that since. I think it's trading below that right now, actually.
Yeah, it is.
And, Coinbase has just continually hit new all-time lows. It's valued at less than $7.5 billion right now. This is a new type of market. I've never seen this in crypto. Usually in crypto, everything's just correlated to one. But because there's VC unlocks, because Wall Street thinks Coinbase is like FTX, because the narrative is shifting from utility and application and adoption on Ethereum versus digital pet gold, pet rock on Bitcoin, the market is just changing drastically. And so I wouldn't say it's been a standstill. I think the market is kind of telling you where things are going.
Mm-hmm. What do you like in crypto that's not on the Ethereum blockchain?
I mean, there's good, I respect Cosmos. It feels like they're doing really good work towards decentralization that honors a lot of the core values of crypto. There's a lot of really good application teams, even teams that are on, Solana or, other different types of chains. Polygon is interesting and has a really good BD team that's focused on games. I think at the application layer, that's kind of where the things that, even though they're on Ethereum, I gravitate the most naturally towards. And then, the new learning area for me is just games. And those are people that have very little crypto context. Not only do they have little crypto context in terms of how to build it, but they don't have a great context as to what it's useful for. And so designing new types of economic models that sit on top of Ethereum that are inherent to a game, that's the other stuff that I enjoy working on and have a lot of respect for.
All right, now the opposite question. What do you think is a project in crypto or an asset, a blockchain or a crypto coin that you think is kind of the most overrated? It has still a long following, but you think it's long been disproven to be of anything of value.
Let me pull up
CoinMarketCap.
I mean, Jesus, there's And I'm not trying to be negative here. I just don't like things that give crypto a bad name. And I think one of the main learnings that I have from last year is that, like, I'm not in crypto. I'm an Ethereum investor. Because Ethereum is the thing that embodies the values that I care about, and I think also has the highest chance of a, really big outcome. But, I think Dogecoin is pretty embarrassing for the industry. I think Cardano is very embarrassing for the industry. These are both top 10 coins. XRP is embarrassing.
Ripple.
Ripple. A lot of the base layer chains that have very little usage and high valuations. Shiba Inu token is still worth $5 billion. There's a lot of things that are embarrassing, but, we've all, like, it's like saying, I'm a growth stock investor.
Yeah.
What does that mean? Like, do you have one of the good companies or do you have one of the bad companies? And I like to think that I have the former, but there's a lot of the latter in crypto as well.
Mm-hmm. So just to clarify, you said you respect Cosmos and Polygon. Do you have any investments in things that are not associated with Ethereum? Or if you do, what percentage is it?
Very low.
Very low. Okay. So you are an Ethereum true and true.
I don't know if I would call myself a maxi or anything like that, but
yeah.
I've just been in this industry for most of my adult life at this point, 10 years. I'm just too old for, playing around with things like, Bitcoin's great, but it's not doing anything. It's not really technology. Cardano, Dogecoin, Shiba Inu coin. Like, I actually want to go home and be proud of being in the industry and be able to point to use cases. And I think those are actually direct headwinds to me being able to do that. And so my hope is that Bitcoin kind of ossifies between, things that really, or crypto ossifies between things that really embody its values, and we kind of sunset the other ones, or at least stop, publicly caring about them.
Vance, it's been great to get a chance to pick your brain. People can find you on Twitter at Pythianism. You very active and post a lot of interesting takes. What's Pythianism?
That's an interesting one. It was an old randomly generated email of mine, and I just decided that it sounded cool, but it sounds mysterious, so people give a lot of credence, I think.
Yeah, there we go. Well, Vance, thank you, and thank you everyone for watching.
Thanks.